Hello and welcome to another edition of Hardman Talks. My name is Richard Angus from Hardman Co, and I'm delighted today to be joined by my colleague, Nigel Hawkins. Good morning, Nigel.
Good morning to you.
So Nigel, you have just published a report earlier this month on the UK public sector net debt situation and posed the question, is this out of control? Other commentators have also suggested that PSND is indeed a ticking time bomb. So this is a perfect time to have a lively debate about this topic. Would you like to start off, however, by just explaining to everybody exactly what makes up PSND and why it has soared in recent years?
Well, the public sector net debt is essentially the deficits run up by government on a year-to-year basis, which is accumulated. And certainly in recent years, it has absolutely soared and is now close to £2.3 trillion, an enormous figure. And in fact, if you look at the numbers, it has gone up by around 8 times since 2001. The combination, I think, particularly of the recession caused by the banking crisis of 2008 and 2009, and the massive expenditure as a result of COVID-19, have really boosted the deficits. And there comes a time where you wonder, can that figure actually be brought back?
So are you particularly worried about this current level of 2.3 trillion?
I think it's a very, very big number and does give rise to many concerns. Having said that, in recent years, it has been readily financed, and the Treasury is pretty confident that there is no massive problem. But having said that, if things started turning, for example, if the interest rates across the world went up, particularly driven by the yield on 10-year American bonds, and if, for example, China reduced its support and investment in those bonds and pushed up worldwide interest rates, then financing it will be far, far more challenging.
So you think we are potentially quite badly exposed to increases in interest rates? So if interest rates were to double from current levels, what sort of impact might that have on the situation?
Well, the Treasury has recently published figures suggesting that a 1% rise in interest rate would put almost £30 billion on the interest rate bill. But again, the Treasury is using a 1% increase. You only have to look back to the ERM crisis of 1992 and see that interest rates can go up very substantially more than just 1%. And once they do start going up, you could find a nasty effect of various other problems arising, the impact on the pound and so forth. And the net result would be that potential investors would say the risks have certainly risen, and the Treasury would have real difficulty, I suspect, in financing those sort of increases.
So do you think there's a general acceptance, though, that higher public debt is part of everyday life and will continue to be so? And therefore people tend to be a little bit more relaxed about this potential problem than they should be. And I think we can look back into other crises in the past that have risen almost out of complacency or a fact that we will essentially kick the can down the road and deal with this problem a bit later and everything's going to be okay. So for the time being, let's just carry on as we are. Do you think we have a problem here in terms of perception?
I think that's a very sound point, and there's no doubt in recent years, the public, the electorate as it were, has become far more accustomed to net debt rising each year, more expenditure being required on the National Health Service, on Social Security, etc. And it's going to be that much harder, I think, to cut back compared with 30 or 40 years or so ago, when, particularly under the Thatcher regime, it was seen that too high a net debt had many, many issues. And I think it's going to be much harder with the sort of expenditure we're seeing on COVID-19 and indeed the impact we've seen on the lower tax receipts as a result of COVID-19, irrespective of all the efforts to push more investment into the north of England. Put that lot together and it's going to be very, very difficult, I think, to cut back. And there is a public acceptance, I think, that yes, let's carry on spending, that's fine. But there are a few people, and we've seen commentators recently saying, look, we're getting to a real risk situation. My own view is that there will be some cutbacks over the next few years, but it will be very dependent upon the economy growing and bringing back the public sector net debt as a percentage of GDP ratio, which has risen sharply over the last decade or so.
So if we look back in the past, and I think in your report you referred to, for example, the Napoleonic Wars, it was very clear why the money was needed. When you have to explain to the man in the street now why there is this imbalance in our financing, you can talk about COVID, you can talk about other elements, but can you define more closely where the excess requirement is basically coming from? Because we're spending essentially more than we're earning in very broad terms.
Yes, public expenditure has risen very sharply over the last 10 years or so. If you actually look at public sector net debt, it has actually gone up since 2010 or thereabouts, very sharply indeed. And as a result of that, there's going to be, I think, real concerns about interest rates rising. And I think the government's really going to have to tackle public expenditure head on and start saying no to various projects, no to various areas of expenditure, because otherwise there is a real risk of it effectively being unfinanceable.
So if we were to take a number of, let's say, 3 trillion, do you think it's ever possible to sustain that sort of level of public sector net debt? Or do you think before we get to that level, we'd have had to take other action?
I think it's very difficult to project an individual number and saying, yes, that level becomes unsustainable. But the 100% of GDP is seen as a fairly useful guideline. Once it goes materially above that, it becomes much harder. Yes, it could be financeable, but at higher interest rates. And I think perhaps a more relevant comparison actually is with the IMF crisis we had in the 1970s, when the UK's borrowing did get out of control, albeit at far lower numbers, nominally at any rate, compared with today. And an emergency loan was granted by the IMF amidst great political controversy. And it may well be that a few years down the line, that scenario does reappear unless the government really responds. You could argue too, of course, there are many, many other countries apart from the UK out there where borrowing levels are far too high. In most of the advanced industrial nations, whether it's France, whether it's Italy, Spain, whatever it is, spending and borrowing is far too high, and that may well be reflected on other countries having similar problems.
So far, inflation has not been a problem for the last few years, and we haven't also talked about inflation in this particular conversation. But would you like to add any comments about inflation and how, in the context of the UK public sector net debt situation?
Yes, the inflation is very important, and there's no doubt that markets and fund managers are increasingly concerned about inflation. Recent American figures have been worrying on inflation levels, and the UK we're seeing a higher inflation. Yes, compared obviously with the 1970s, the inflation levels are very low. However, once inflation gets a grip, it is actually quite difficult to rein inflation back to far lower levels. I think that will be a concern, particularly since the UK itself has quite a large significant proportion of index-linked gilts. And clearly, if inflation goes up, the cost of servicing those gilts is considerably higher. And you could see a toxic mix, for example, of possibly a recession, higher inflation, and inability to draw in public expenditure, the Chinese cutting back their investments in American bonds and pushing up interest rates. Put that lot together, and it could be nasty. The other way around, you might say, yes, the economies may grow and so forth, and you can afford it. But my own view is I think government has to be extremely careful in taking a fairly laid-back attitude to public expenditure. And it's something I think the Treasury over the last few weeks is really focusing on.
So if you had one key message to give to our Chancellor of the Exchequer, what would it be?
Really look at the public sector net debt, how you can constrain borrowing aggressively. A number of projects, High Speed 2 is an obvious case in point, costing a vast amount of money. Do they really need to go ahead? Is it absolutely compelling? How else can we reduce public expenditure? And a lot of waste still in public expenditure. And I think the Chancellor is now saying, how can we actually save money and really get public sector financing under control?
So my final question, a more specific question, what are the implications for the unfunded pension liabilities for public sector employees?
Yes, that also is very relevant. The figure of close to £1.9 trillion is again a vast one. Yes, it is over and above the public sector net debt figure, and 600 billion, for example, relates to future pension requirements on the health service. Most people accept and say, yes, they should be properly paid. On the other hand, it's a big liability. And frankly, if it were British Telecom or other major companies who have to account very clearly for pension liabilities, that massive figure should also enter into the mix.
Nigel, it's been delightful to talk to you again. We're out of time, so thank you very much. I look forward to talking to you again on another interesting topic. Thank you so much.
My pleasure.